We often say there's basically two camps of what I call value management: the Stock Appreciation Club and the Earnings Club. The Stock Appreciation Club is really focused on kind of that what I call the reinvestment kind of growth mode. We're taking lower distributions, lower dividends, lower bonuses, whatever you want to call it, kind of dumping that money back into the company to push the value up. And that's the best strategy for most firms. Let's be honest, there's a whole bunch of baby boomers and a whole bunch of millennials, but not very many Gen Xers in the middle. So a lot of firms have ended up with this kind of an hourglass org chart, so to speak, where they don't have a huge next gen bench of 40 or 50 something leaders. Now, that's becoming less of an issue because now those millennials are in their 40s, and what's happening is they're kind of skipping over that issue. But it's the leadership transition.
Hi everyone, and welcome to Design Development, your hub to learn direct from top performers in real estate development, design, and construction. I'm your host, Renz Hayes, founding partner of H&O, lifelong learner, and I am personally obsessed with high-powered organizations and the leaders that guide them. If this is your first time listening, thank you so much for tuning in, and if you're a returning listener, welcome back. Let's go. My pleasure to introduce today's guest, Greg Hart. He's the president of PSMJ Resources, Inc. They are all around the AE space. They are consultants, educators, they host events. They really do everything except the architecture and the engineering. So they are a great resource for everybody in that field. Today's conversation is about business valuation, succession planning. How do you evaluate a business? How do you improve the value of a business? We talk about AR and the importance of having a handle on your financials when you're entering that phase of a business's life cycle. Even if you're not thinking of transitioning a business or selling a business worth selling is a business worth keeping. So learning about business valuation and how to evaluate a business is a really important skill for any business leader. Let's get into my conversation with Greg. All right, please join me in welcoming Greg Hart. Greg, thank you so much for joining us today.
Thanks, Renz. Glad to be here.
I, for one, am excited to share your knowledge with the industry. You have experience in mergers and acquisitions. You've consulted on many of those deals, both internal, external. That's succession planning. That's a merger. That's an acquisition. All of those things. It's not something that a lot of people are even exposed to before they're like, hey, I want to retire or sell my business to my employees or to somebody else. How do I do that, right? So that's what we're going to get into today. But before we do that, Greg, could you tell us a little bit about you and what PSMJ is all about?
Sure can, Renz. Yeah, so I'm the president here at PSMJ Resources. I'll give a quick overview of PSMJ and then talk a little bit more about my background. So PSMJ, we are 100% focused on the business of architecture and engineering. So project management, financial management, human resources, basically everything but the design we get involved with. And we do it in a few different ways. We have a publishing and research business. It's funny, when I talk to folks about PSMJ, one of the first things they mention to me when they hear that name is our annual financial performance survey, which is a veritable boat anchor of metrics, of key performance indicators on just about every aspect, financial and operating aspect of an architecture engineering firm. So that's in our research business. We also have an events business, which probably the second thing that people say they think of when they think of PSMJ is our project management boot camp. So several thousand project managers, aspiring or current, project managers go through that every year. We also have several conferences and several other seminars, both virtual and in person. Again, all focused on those business of architecture and engineering topics. Then kind of a natural offshoot of that over the years has been our consulting business. Advisory services, again, on virtually every facet of that. So project management, financial management, HR, like you mentioned, mergers and acquisitions, certainly a big part of our business, as well as ownership transition. And then we also have a metal construction trade show called MetalCon, which is an annual trade show that is a little bit of a twist on everything I just said. And that MetalCon is installers, fabricators, contractors. It's everything about the building of metal construction, and design. So that's a little bit about PSMJ. It's like hard to sum up in 30
There's
seconds
a
what we
lot
do at
there. Yeah.
PSMJ.
Quite the elevator pitch, right? It's a long ride.
It's a long ride, yeah,
The
for
thing
sure.
I admire most about PSMJ is the synergy amongst the business lines. There's different entry points for everybody for you to provide value to like a very broad part of the industry. Your niche
Yeah,
in the industries that you serve, but you literally can provide value to anybody in that industry, right?
that's right. That's right.
And they're different price points. You have the educational stuff, you have the events, and then you have the one-on-one consulting for big core things, the HR, the mergers and acquisitions, the business valuation, the transitions. I think that is all amazing stuff. The second piece that I think is really fun to share it gets architects and engineers really thinking about your business. We are used to doing work and then waiting to get paid.
That's right.
You don't do that, do you?
We don't. There's a couple core principles that in virtually all of us who are in the consulting at PSMJ or in the management positions at PSMJ have worked in architecture and engineering firms, right? So we've seen what works, we've seen what doesn't, and we really do practice what we preach. So one of the core principles that we kind of started the business on is accounts receivable is a drag for everybody, especially in architecture and engineering firms. So yeah, right. Virtually everything we do is paid up front. We don't want to get in the business of financing for our clients, and we know that architects and engineers don't want to get in the business of financing for owners and developers. That's always a challenge. That's always one of the biggest issues we see in our annual financial performance benchmark survey report. AR aging, I mean, that could grow you right out of business if you're not keeping an eye on it. So you're right. A lot of the stuff we do at PSMJ kind of gets away from that, and that tells you a little bit about some of the principles and the principles that we kind of try to really, really, really inject into our clients when we work with them, for sure. For sure.
Yeah, and so for those, I'm sure we're going to have listeners that they don't have the benefit of seeing the financials, right? So accounts receivable might be a new term to them. So could you tell us what are accounts receivables and what does it mean when you talk about AR, aged AR?
Yeah, you bet. So there's sort of three facets to running an architecture and engineering firm. There's you do the work, you get paid for the work, and then you manage the other stuff in the business, all right? The getting paid for the work, now this depends a little bit on where you are in the pipeline, whether you're a prime or you're a sub or kind of where you are in the pecking order, but getting paid for the work can be a challenge for a lot of organizations, and a challenge in the sense that every day that you're not getting paid, you're still paying out payroll, you're still paying rent, you're still paying all of your operating expenses. So the longer that drags out, the more that capital has to come from somewhere, and inevitably it comes from you if you don't have that cash flow coming in. So one of the metrics that we look at, in fact, it's part of our circle of excellence, which is kind of something we can talk about later, but the kind of high performing firms in the industry is how long it takes you to get paid. So it's the number of days in terms of gross revenue. So if you take your accounts receivable balance, that's work that we've completed, work that we've billed, but we haven't been paid yet, and divide that into your gross revenue, you come up with a number, and that's the days of. And you do a little other math to kind of get to a monthly value and daily value and things like that. But basically, you're saying, I want to take my AR balance in terms of how many days of gross revenue that is. And that's what you look at for the metrics. So for some firms, it's 50 days. For some firms, it's 150 days. But every day that goes up, it means cash is coming from somewhere else to make payroll, to fund the operations and things like that. And it's funny because a lot of times some of the hiccups, there's a lot of pay when we get paid issues that if you're further down as a sub, you're going to have to deal with. But one of the things we often see too, there's some simple administrative project management things that you can do at the outset to get paid faster. One example I love that one of our client firms does is at the start of every project, gets a sample invoice in the hands of the client organization. Oftentimes, the only thing holding up payment is it just needs maybe an internal number, an internal tracking number or something like that on it, and it can go through the system much faster versus sitting in an accounts payable filing bin or something
Wow,
like that.
that's a really
So,
great piece of advice.
right, there's little tips and tricks like that. It's not always, it's like, well, we're sub, so we're always the last one to get paid. There's
Hmm.
some things you can do to grease the skids a little bit and speed up the process. But accounts receivable, in terms of the number of days of gross revenue, is a metric that every firm should be tracking if you're not tracking it already.
Thank you for walking us through that. That was a little bit of a sidetrack on a conversation, but a topic that I am very big on, and I'm trying to bring that education to the industry, and
Sure.
this was the perfect opportunity. So thanks for sharing.
You bet.
And it actually is a great segue into business valuation. We look at there's two key metrics in business. We call it cash flow and profit. You need both of those to be sustainable. And when we're talking accounts receivable, that's a direct measure of your cash flow, right? And so if we go into like, how do we evaluate business? What is my firm or what is your firm? Like, how do we look at a company and come up with a market valuation for that? And I think one of those metrics that might impact that valuation is cash flow,
You bet. You bet.
right? So could you talk to us a little bit about business valuation? Let's think from the perspective, I don't know anything about evaluating business. I'm an engineer, an architect. I'm running a firm, doing good work, serving clients. Like, where do I start?
Yeah. Yeah. So yeah, and I'll give you just a little more background. I told you a bit about PSMJ, and I'll tell you a little bit about my background and how I kind of got into that.
Perfect.
So I actually started out my career in an environmental geotech engineering firm. I was a technical professional, loved what I did, but realized that I wanted to do more than that, and ended up going to business school, got an MBA, ended up getting into this side of helping firms work on the business, and naturally found that business valuation was a lot of fun because it's a little bit like a puzzle that you're trying to put together and figure out what drives value in an organization. And the funny thing is, this industry is a little unique, right? I mean, it's a people-based business, much like legal, accounting, and some of those other professions. But the things that drive value in it aren't necessarily the things that drive value in other industries, right? We don't have a lot of patents and tangible assets and things like that. It's a lot of intangible goodwill that drives value. I mean, the your website and your brand and all that kind of stuff doesn't really show up on your balance sheet as a tangible asset. Okay, so that's where it gets a little tricky. I say a little fun to value an architecture or engineering firm. So you're right. I mean, cash flow at the end of the day drives the business, and it's easy for people in any industry say it's just a multiple of what we call EBITDA, which is your earnings before interest, taxes, depreciation, and amortization. For the context of this discussion, effectively your operating profit. And valuation is typically a multiple of that, 4, 5, 6, 7 times that. But there's a lot more to it than that, because if we just said it's based on your EBITDA, my next logical question is going to be, well, what EBITDA? Last year, next year, 3-year average, 5-year average, and
Forecasted EBITDA.
right, you're right. And the forecast is always a little bit of a hockey stick. I mean, it's always shooting up. And you and I both know, you've been in this business long enough to see it booms and busts. It's never completely flat. It's going up or it's going down, and it's sort of hard to pick a representative value in there. So you start to look at other things. You start to look at client concentration risk. You start to look at ownership concentration risk, especially if some of those owners hold a lot of the key client relationships and they're looking to retire soon. You look at project profitability. Oftentimes, certain types of projects, let's say transportation, can be much less profitable than other types of projects, let's say commercial land development. But we all know that transportation, I was saying before about AR, can be one of the slowest ones to pay versus some of the others that can be fast. So you can't just look at the profitability of each type of project. You have to look at that client market and what the growth potential is in that, especially for a bigger organization who's in a bunch of different markets. So you start by looking at the company's earnings and things like cash flow, but then you dig, there's an onion there that you're going to start peeling back to look at all these different things that drive that EBITDA and how reliable that number would be going forward. When we get into due diligence, we call that a bit of a quality of earnings assessment. We're really looking at how reliable these numbers and what's behind them. But even in that initial assessment, candidly, whether it's for an external transition or an internal transition, you need to look at some things like that, like what's driving this earnings before I just slap a multiple on it and say that's what the value of the company is. I need to know what's behind it, and it's clients, it's project management, it's claims, it's all that stuff that ties into EBITDA for sure.
You mentioned a quality of earnings report there, and there's if it was that clear as a multiple of EBITDA, we'd say, hey, architecture and engineering firms are worth 3 times EBITDA or 1 times EBITDA or 5 times EBITDA. Yeah. But it's who actually came up with the calculation, like what is EBITDA? And if I were to share my story, I'm an engineer, right? I excelled at math for most of my life. So when I was told like you should really go get educated in like business financials, I was like, I can add and subtract. I understand cash flow and a P&L. There is way more to it. So if I'm talking to somebody that's trying to evaluate their business, one of my first questions are like, are you a self-taught accountant? Do you only have a bookkeeper, or have you had somebody at a higher level, a fractional CFO or like an accounting firm come and like rip through your financials and make sure you're organized properly?
Yeah. There's a couple things that absolutely, before you even entertain the discussion or the possibility of selling your firm, that you really need to look at. I mean, there's a lot of advice out there that your firm should always be what they call transaction ready, which if a buyer came knocking tomorrow, I could give them clean financials and I could show kind of exactly here's where we're at. Mm-hmm. But that's easier said than done. It's one of the biggest issues we see with smaller firms is using what we call cash basis financial statements versus accrual basis. Now, cash basis statements is basically we recognize revenue when we receive the check. We recognize an expense when we pay that expense. We write the check, basically. And that's you want to do that for tax reporting and things like that. But for a true representative picture of the company's operating performance, you want to look at when revenue is earned, okay? And that's where you get to more of an accrual basis financial picture, which is a much more representative level of earnings for the company. And you're also going to want to take out what I would call non-operating assets. You know, smaller companies may have certain non-operating assets and expenses mixed into the company. We'll want to clean that out. Sometimes you want to look at owner compensation and make sure the salaries we're attaching to those owners are market-based, because that's not always the case in the day-to-day operations of the company.
That was a hard one for me to wrestle with early in my career, and I feel like we're finally confident and have our head wrapped around that. And I even know in smaller firms, or let's say from a smaller firm is an EBITDA less than $2 million a year, right? There's a big kind of number at $2 million, $3 million in EBITDA, where to achieve that type of financial performance, the assumption is that your company has a certain level of organizational quality to be able to maintain that, right? So under that, you can have that key man risk, that ownership risk, like that leadership risk. Yeah. And they almost refer to it as seller discretionary earnings, because most small business owners don't separate their personal value as an operating position in the company versus their return as an owner, as a shareholder of the company. That's right. Could you talk a little bit about guiding people to how to maybe think about like their income or their compensation as an operating executive versus shareholder?
Yeah. I mean, the easiest way to look at it is, all right, if I bought this company and I had to put a management team in place, what would that cost me? You know, and you're right, SDE, that seller's 100%. Discretionary expense, is a very common term in, I would say, like general industries. You know, if you have a dry cleaner or a gas station or something like that, I mean, your income is basically just that, the seller's discretionary earnings at the end of the year of the operating profits of the cash flow of the company. But you know, in an architecture engineering firm, I want to look at like what is the, and especially in a merger or acquisition, an external sale, I want to look at on day one after the transaction. What salaries am I going to, this ownership or leadership or management team is going to fall under my compensation model as a buyer, and what's that going to be? Okay, now you have to be careful there too, because it's easy that we sometimes joke that, you know, if you're a buyer, you can kind of manipulate an EBITDA number quite a bit by attaching corporate overhead of the buyer. So, and there are plenty of cases where a small firm is doing really, really well on their own, right? and they're almost doing too good to sell. They're almost too successful to sell because the only thing a buyer is going to do is dump a bunch of overhead on that and drive the profit down. So those are actually cases where it's like, man, just run that thing as long as you can because you're not going to find a buyer who's going to do anything but bring that down. But at the same time, you've got to be looking at that if you're a seller. That is, if I think a reasonable EBITDA, let's just for the sake of example say $500,000 or $1 million, and the buyer's saying no, it's more like 200,000 because once we attach all of our corporate overhead, that's a corporate tax. I mean, you can't. That's your problem, not mine. If I'm a seller, because I have no control over that. I mean, you can manipulate that all you want, but at the same time, it is important to attach some of those market-based salaries. And we have benchmark data on that. That's the reason we do our annual management compensation survey is to make sure you have a benchmarked value for a median CFO or CEO or COO that you can attach for a firm of your size, because it just doesn't make sense when we see that there's virtually no or really under market salaries for the executive team. It's totally fine in the day-to-day operational context. We get it. But in terms of a merger or acquisition, you've got to attach a market-based salary. Otherwise, you're essentially artificially inflating the company's earnings.
Yeah, like as an executive, if you underpay yourself and your company is on the smaller side, let's say in that $500,000, $1 million EBITDA, and you underpay yourself as an operating executive, your profit margins are going to look pretty healthy, right? But if you were to pay market value to replace yourself, those margins would go down.
Yeah.
And I think your example there of a corporate business, a corporate entity buying a smaller business, they're going to look at their EBITDA differently. And it's not necessarily, if something's worth $1 million to you, it might not be worth $1 million to somebody else, right? It's in the eye of the buyer and the seller, and there's got to be alignment for a deal to get done.
That's right. And I think that's incumbent on the seller to make sure he or she finds the buyer who sees that circle peg in the circle hole. That if you're heavy, in healthcare or a certain niche of healthcare or whatever it is that you're bringing to the table, you want to find a buyer who sees optimum value in that, what we'll often refer to as kind of strategic value. In fact, in some cases like that, a buyer might say, I'm actually gonna kind of almost overpay for this acquisition because we see so much upside and so much opportunity with that niche that this seller is in healthcare or whatever the case may be. That's the funny thing about business valuation is it really is as much art as it is science.
100%.
There's not always a right answer. There's definitely some wrong ones, for sure. But there's never a single right answer. I mean, it really depends on who the buyer is. And by the way, it also depends on the structure of the transaction.
Terms.
Right?
So you set the price, I set the terms. There's a deal to be done, right?
I mean, if I'm a seller and I have two offers, but they're the same value, but one is 100% cash at closing, and one is, let's just say, virtually zero cash at closing and financed out over 5 years, I'm going to take the one that's 100% cash at closing. In fact, I might even take a lower valuation for that one because that's got the cash at closing. You can almost do a little bit of net present value math on that. But
risk of closing the deal, of hitting an earnout, right? There's inherent risk of not having the cash now.
That's right.
And I would say are earnouts really common in AE transactions?
They come and go. I think they become more common when either times are a little uncertain or a firm's performance is a little uncertain. So earnout basically is, hey, I think as a seller my company's worth $4 million. You think as a buyer it's worth $3 million. How about we agree on $3 million, but if I do X, Y, and Z over the course of however many years or months, I get that additional $1 million. And usually it's a revenue target. Sometimes it's a profit target. Things that are pretty black and white. I mean, I never like to see them more than like 20% of the total transaction consideration. And honestly, all things being equal, you kind of prefer not to have those. There are some buyers, some bigger, well-known buyers who will never use them because they feel like they're divisive. I mean, if you're a real full-on integrator and you want to just merge this team in, the last thing I want to do is keep separate books because I got to track this stupid earnout.
Yeah.
You know?
If anything, when I think of a healthy earnout, it's if it's above and beyond your strike price. You already got what you wanted, and now you're both aligned in making this a better deal than to make it really successful.
Yeah.
We started driving when we talked about business valuation. We started talking about it through the lens of a buy and a sell, an acquisition. And to share some of my story, I got exposed to mergers and acquisitions in 2017, 2018, and it completely changed the way I looked at business. So at the time I was running a steel business, running the engineering business. I'm reading every book under the sun. I'm listening to podcasts. I'm talking to industry peers. And I feel like I'm gaining all of this industry knowledge in management and operations and a business. And I felt like a yo-yo in the middle of a business. Like I always felt like I was starting from the middle, and I was like, where the hell do I start? Where do I start? In mergers and acquisitions, I got introduced to somebody that actually was running a holding company. They were trying to acquire up to 10 businesses so that they had a portfolio of 10 businesses that spun off X amount to him and X amount to his investors. And that was like the industry. And I was like, wow, that's really interesting. And it got me down the path of like, how do you assess like the valuation of a company? How do you go about buying a company? How's this? So I started networking heavily.
Yeah.
And I stumbled upon the Certified Value Growth Advisor program that taught me how to look at a business, how to like, what is proper strategic planning? Where do you start? It's the mission, vision, values. That's for another day.
Yeah.
So to those thinking or listening to the conversation that haven't thought about succession planning, haven't thought about buying and selling a business, this conversation is still for you, because a business worth selling is a business worth owning.
That's right.
And when I think of my income as a business owner and operating executive, I think of it in three different ways. One, my income, my salary based on my position in my own company. There's the performance bonus that's tied to that, right? Which is baseline comp. Then there's the profit sharing, like relative to organizational performance that year. That's relative to the amount of shares I own in my own company. And then the third one, and the one that's mostly overlooked, is enterprise value. Like, are we increasing the value of this stock over time? That's a non-taxable event. And if you do private business well, when you own a private business, you're able to spend money, invest money in your company tax-free because it's called an expense, right? But if you can spend money and create a wheel where you can invest in your own company, you can increase value.
That's right.
That really builds wealth over time, right?
Yeah, and it kind of ties into your strategic plan as well. You know, we often say there's basically two camps of kind of value, what I'd call value management, and there's the clubs, we call them, the Stock Appreciation Club and the Earnings Club. And the Stock Appreciation Club is really focused on kind of that what I'd call the reinvestment kind of growth mode. So we're taking lower distributions, lower dividends, lower bonuses, whatever you want to call it, and we're kind of dumping that money back into the company to push the value up. So we're investing in growth through acquisitions, strategic hires, marketing, tech, innovation, you know, all those things that you expect to see in a growing company, which is fine. And that's the best strategy for most firms. But then there are other organizations that operate what I would call kind of an earnings club. And that is basically the value of the stock is pretty much flat throughout the duration of your time as an owner, but you're getting distributions instead. You know, so you're just sort of cashing out, and rather than putting that cash back into the business, we're just pushing it out to the investors every year. Pros and cons to both of those models. I think you're absolutely right. The Stock Appreciation Club is often the model that makes the most sense for a lot of firms, especially growing firms. But I've seen some organizations that say, look, you buy in, you pay in $100,000, and when you leave 20 years later, you get your $100,000 back. End of story. And during those 20 years, you're getting the access to capital, access to cash flow. But that's a company that's not going to grow significantly.
That's a company that's not growing. So if we could provide some advice or intuition from your experience, because you get to see so many firms in the industry and different disciplines within architecture and engineering. So if someone's sitting here thinking like, I would love to increase the value of my firm, right? Like I want to calculate the valuation of my current business and I want to start to measure that over time. What are like the low hanging fruit or the most common areas that when you get involved with a company, you see opportunity to improve the company and increase their value?
I think the biggest thing is concentration of anything is risk. So if you have one key client that's 15 or 20 or 30% of your revenue, that's a risk. And in some cases, it's a lot higher than that, 50 or 60%.
Mm-hmm.
And it's not just revenue. If you have one key client that's responsible for a lot of your profit, the same issue applies there. So the first thing you got to look at is that, are we too overly concentrated on one client for profit or for revenue? The other thing you got to look at is how much institutionalized value do we have? Another way to frame that is how much transferable value do we have? So if one of us, and let's say we have 3, 4, 5 kind of key owners and key leaders, if one of us were to leave, what would be the impact of that on the firm, as far as business development, client relationships? When I was worried about kind of back office management, it's usually more on the client side.
Mm-hmm.
The reality is, with a lot of organizations, with a lot of AE firms, the ones who have the most power aren't the ones with the most ownership. They're the ones who bring in the most work. The ones who have the most
Mm-hmm.
business development responsibilities. So you got to look at that and think about, what am I buying as an external buyer, but also as an internal buyer. And we say internal buyer, we mean kind of next generation of leaders within the organization. What am I buying? No buyer, external or internal, wants to simply fund a retirement. That there's no real value creation in that. So you really got to look at that. What's the institutional transferable value in our organization that a buyer would get? And oftentimes, Renz, that starts with whose name is on the door. If it's Greg Hart and Associates, then you've got a problem, right? You've got to look at how much value is tied to that one individual. So there's
Mm-hmm.
things like that you got to look at to make sure that we have a going concern, to use an accounting term, a company that has kind of a staying power. It's a real organization and not just a lifestyle business attached to one or two individuals, which is fine if that's all you're after. But if you're into kind of creating something that will have a legacy, you've got to start looking at that institutional value for sure.
Yeah, and so that risk or the areas to kind of focus on are look for concentration in clients of revenue and profit, not just one or the other, right? Because not all clients and not all revenue is created equal.
right.
If you think of the what is it, the Pareto principle, the 80-20 rule, like chances are 80% of your performance come from 20% of your clients or projects.
Right. The
Pay
Pareto
attention
rule is
to that.
bad for valuation.
It is not good for valuation. But if you're looking at keeping your business or you want to start improving the value of your business, that's where you start to look. And whether you sell today or not, and you just hold it, it's going to be a higher value asset for yourself.
Yeah, you bet.
Let's talk about. We're gonna follow up and get into two different topics. We've kind of brushed on both of those. One is succession planning, and then mergers and acquisitions. So I think first I want to talk succession planning. It is so hard to transfer an architect and engineering firm, which is why succession planning in the AE industry is so common, right? Because you have people that are familiar with the operations of the business, familiar with the key man risk, familiar with the team, and it's like a natural progression. Could you talk to us about like things that company can do to start preparing their team to be able to take over a business?
Yeah, it's funny. I think the biggest challenge there isn't so much the ownership transition as it is the leadership transition. Time and time again, that's the comment we get. It's not so much, I mean, there's the financial mechanics of kind of figuring out the kind of engineering the transition. But it's funny, I had a CEO comment to me the other day when thinking about his transition plan. He said, you know what? It's really easy to get into this business. It's really hard to get out. And he was referring to that it's
That's such a great statement.
yeah.
What a quote.
There's a few reasons for that. I mean, look, let's be honest. just the natural population demographics don't favor ownership transition very well, because there's a whole bunch of baby boomers and a whole bunch of millennials, but not very many Gen Xers in the middle. So a lot of firms have ended up with this kind of an hourglass org chart, so to speak, where they don't have a huge next gen kind of bench of 40 or 50 something leaders. Now, that's becoming less of an issue, because now those millennials are in their 40s, and what's happening is they're kind of skipping over that issue. But it's the leadership transition that's hard. And the other thing that's hard there too is where external sale is, for all intents and purposes, an event. I mean, if you're going to sell your firm in a merger or acquisition, there's a date that the closing happens, and obviously there's some prep beforehand and negotiation beforehand, and obviously there's usually a period of time afterwards where there's a promissory note or an earn-out or something like that. But
it takes a long time.
But internal transition can be a 10-year process. I mean, that's something that doesn't just happen as an event. So you've got to start looking at that in terms of how do we either identify or groom our future leaders to take over this firm. I hear plenty of situations where that next gen just says, frankly, we're just not interested.
Wow.
We saw our parents work themselves to the bone and then die of a heart attack at 58 years old or something like that, and we don't want that life. So we want more work-life balance, and being an owner isn't consistent with that. So you got to navigate through that and make sure you find those individuals who have the fire in the belly and see the opportunity to grow this thing and to make it a lot of fun.
Yeah, so the leadership transition is more challenging than the ownership transition. We can come up with a number in a document and hire somebody to walk us through that.
Yeah.
But it's actually making sure the people on your team, one, want to run a business, and two, you've given them exposure to the business, the strategy, the financial side, that they're actually in a position to be successful when they take over.
Yeah.
Right. We can't learn how to run a business by being an engineer or being an architect. That doesn't teach us how to drive the ship.
That's right, Renz. And it's funny. I think back to one of the first strategic planning assignments I was involved with, 14 or 15 years ago. And we're sitting, and this was probably a 150 person engineering firm, and we're sitting there in this boardroom, and you had this one CEO who was really frustrated because he felt like this bench of leaders who are all 50s, 40s, whatever. His basic frustration was, when are they going to step up and show some leadership and take some, not ownership in the literal sense, but really kind of take ownership of executing and running the firm. And their comment was the exact opposite. When is he going to get out of the way and stop micromanaging and stop having to have his fingerprint on every single thing in this company? And it's funny because and there was some cultural clash there too, right? I mean, his mindset was, hey, look, the way I run this firm, I'm in here 5 days a week doing work, and then I'm here all day on Saturday. I think he said he'd be until Saturday till 1 or 2 o'clock, and then he'd go golf in the afternoon on Saturdays. And he was there morning, noon, and night, Monday through Friday as well. And his frustration was this next gen, 5 o'clock, they want to take off to go to their kid's soccer game, right? And you're never going to see them on the weekend and all that. So there was some cultural collision at play too. But one of the breakthrough moments was this agreement, kind of what you were getting at there, that this next gen of leadership hardly even knew how to read a balance sheet or even some, we were talking about AR, days outstanding, earlier, some of these key basic financial metrics that they had just never been exposed to. So the kind of breakthrough was that the CFO agreed to start hosting these kind of lunch sessions. In fact, he was just like so frustrated being between this dynamic. He said, all right, enough. I'm going to, once a week, we're going to sit on a lunchtime and I'm going to teach you something each week different about financial management. And that's what it took, because there was that kind of collision. So, it's not always that explicit. It's not always that black and white, but oftentimes the conversations aren't happening at all, in terms of are you interested? Do you have the potential? The performance review stuff, all that, to sort of groom that next generation of leaders.
There's lessons for both sides there, right? The ownership team that is sitting there waiting for their team to step up, it's a good time to reflect and ask yourself, like, am I giving them the opportunity and space to? Am I mentoring them in a way that's pushing them to take that leap? And if you're in that like emerging leader role, it's like, are you taking responsibility for investing in learning and building new competencies that are going to allow you to get to that next step of your career? Are you asking questions to learn about it? Or are you just going about your daily job saying, I'm not getting the shot?
Yeah, you know what's funny is in so many of these cases, um, there's that new Taylor Swift song, "Hi, it's me. I'm the problem. It's me." In so many cases, the existing leadership team or leadership individual, when looking for the next generation, is looking for someone exactly like them, and that's almost impossible to find. And I think once you kind of stop, you kind of break away from that a little bit and think, what does this company need for a skill set? Not finding somebody who does things exactly the way I do things or did things. Then you can start to solve the problem and start to identify, hey, look, we're not unlike any other industry where firms go through phases, and there's a time and place for that initial entrepreneurial phase. And then there's a time and place to grow beyond that into a more managed organization. And I think that that's a frustration that a lot of executives will have, is they're trying to find somebody, they're trying to do a one-to-one replacement, and it's usually more like a 1-to-2, 1-to-3.
Sure.
That next generation isn't going to do things the way you did things. They're not going to be in the office every night, and they're not going to be in the office every Saturday, but that doesn't mean they're not working hard. It's just a different model.
Well said. The other rub there is when, let's say it's that one solo owner to three replacing potential owners. If you're looking to make change, you're putting the current owner's money at risk. So there's the rub, right? Like it's almost like you have to be building and understanding that there will be a change, but there needs to almost be an agreement, because until that day happens, if that individual owner hasn't like taken a leap of faith to recognize like, hey, we need to take these chances and invest in our people, and that's ultimately going to create the opportunity in the future, it's going to be a perceived short-term risk to them.
You bet.
And you have to talk about that, right?
And there's also this issue of you start to see this in the years leading up to a transition, that the exiting owners are going to want to back off on risky investments and more just kind of hoard cash, and the next generation is going to be much more bullish on investments. So you have to navigate that a little bit, and sometimes you do end up in situations. We had one also several years back where it was an architecture firm with two owners, and one of the owners said, the day I relinquish control, that is like leadership control, is also the day I want my check for every penny. I don't want my return on investment contingent on their leadership of the firm over 3, 5, 10 years. And that's a tricky part to navigate as well. I mean, if
that's a very hard,
you bet.
That's a stake in the ground when you make an immovable. That makes it really hard to get a deal done.
It's a big check to write. I mean, that's the biggest issue you have there, is that a lot of firms don't have the cash flow to support that kind of transaction.
And I would actually argue the owner that puts that stake in the ground and such a demand to it, like when their intent is an internal transition, what does that actually say? Yeah. Right? And are they actually in the powerful position? Because if their second tier of leadership walks, now what just happened to your business valuation?
So, it's funny. You bring up a really good point there, Renz, and there's a thing that's hard to measure but easy to understand, and that's sweat equity. That you do have this risk and now, you could say, well, we've got them, if they're already owners, maybe we've got them nailed down in a non-compete, and we've got some teeth in our buy-sell agreement and all that. But the reality is, this happens sometimes, where that next generation, they're a lot more entrepreneurial than you might have thought, and they do decide to go across the street and hang a shingle. They do realize that the exiting owner has got him or herself in a little bit of a corner, and sometimes there's a negotiation at play where, and this can happen. This can be problematic too, by the way, where if you have a situation where there's sort of 5 or 6 potential next generation owners, and they're all becoming owners at the same time, there's a risk that they could sort of try to do some collective bargaining, if you will, and kind of start to gain some leverage, realizing that this owner is held on too long as it is. That's not good for anybody. That's going to end as a disaster for everybody. But
I want to say I read that in one of your educational resources. It talked about a story where they tried to negotiate the deal with the collective group instead of individuals, and that exact thing happened, and it sabotaged the deal, and it never got
it
done,
happens
right?
a lot. Yeah, it happens.
It happens a lot.
I mean, I
So
shouldn't
that's
say it
a
happens
good
a lot. It
lesson,
happens more than you think. Yeah, that
more than you think.
owners start to naturally they even if they're presented individually to that next generation, they're going to talk and start to kind of weigh the pros and cons, and absent any like education or instruction or direction, they're going to form their own kind of opinions and ideas, and that's where you run that risk that for sure they'll look at the alternatives.
We're this is an amazing conversation, and I want to jump to like external acquisition type conversation, but I'll leave one thought here in terms of the succession plan. If I think about my own personal strategy as we continue to grow, we're trying to grow a large national firm. Part of how we de-risk that succession transition is to have let it happen gradually while we're still invested, while we're still majority owners, while we're still growing the company. So we already have people already bought into the success of the company. And if we're working on enterprise value, we're building a high quality organization with a strategic plan, with consistency in our financials, and a team that understands and knows how to execute the plan. That makes our business more appealing than trying to go create a competing business to go to another firm, because we have this entity, we have the organizational value that's worth investing in.
Yeah.
It doesn't feel like a risk. It feels like a great opportunity.
Yeah, you bet.
That's how I think about it. So I'd like to jump to acquisitions. Like I said, how does a company even go about buying another firm? Like, do you go on MLS? Like, is there another box there instead of looking for houses? Like, what do you do?
Yeah, I wish it was that easy. And by the way, there are biz buy sell, and there are these websites that have companies for sale across all industries. I mean, there could be a used car dealership next to an architecture firm, next to a bookstore. But here's the thing: buying an architecture or engineering firm, there's like three facets to measuring whether it's the right fit. There's the strategic fit, the cultural fit, and then of course the financial fit, which is like some of the stuff we talked about earlier with, do I agree with the valuation? Does it make sense for us financially? But that's the last thing to measure. The strategic and cultural fit are much more important. In fact, I would argue the cultural fit is the most important. Unfortunately, it's also the hardest to measure. I define
Sure is.
cultural fit as, could I see myself working with these people? Do they think the same way about client relationship management and project management and all of the things that go to running a business? Or are we just at odds? I mean, do I completely disagree? Or can I have a conversation? Can I have dinner with these people and actually enjoy the conversation? That's the cultural fit. Strategic fit is a little easier to measure. That's, are they in healthcare? We're in healthcare. Are they in New England? We're in New England. It's sort of like, what can we do together here? Yeah, I'm getting some competitive threats there. I could see how if we got the resources of this bigger firm, that's a little easier to measure. But so the cultural fit ideally is coming from somebody you've teamed with or gotten to know, even competed against, where you have some existing familiarity. It's kind of funny. We had a buyer once who made a comment to us that, and this is a big successful firm, that the first red flag in a potential seller for us is if they're actively for sale. That's almost like sums up. Why are they selling the company? And there's actually a little bit of truth to that. That most of the transactions that happen are sellers who weren't actively considering an external sale. They were busy running their business, and then this opportunity from buyer X presented itself. So you start to look around and you think, okay, if we want to get a healthcare architecture firm in Miami or wherever the case may be, you kind of want to develop your wish list of firms in that market, whether it's with an advisor like us or some local boots on the ground, networking at industry events. You want to find who the movers and shakers are in that space.
Mm-hmm.
Whether or not they're actively for sale is just completely irrelevant. You really want to look at who the best firms are. You obviously have to think about the right size as well. I mean,
Sure.
in a people-based business, the bigger the firm, the more expensive it is. The more employees they have, the higher the price it's
Mm-hmm.
probably going to be. So you got to look at that as well. But looking at the lists of firms actively for sale, hey, look, every once in a while you find a unicorn, and it happens that the reason they're selling kind of makes sense to you. But the first place to start is just who are the firms that are the best and brightest in what we need in that market.
Very cool. And you mentioned firm size. Do you see like when is it? If I think about my own consideration of acquiring another firm, I think of like what size company makes it worth the time, frustration, and risk of going through an acquisition. Is buying like a 5-person firm even worth the headache, or does it need to be a 40-person firm doing $10 million worth of work? Like, what's the metric? Like, any rule of thumb where you start to see transitions be successful and fruitful for both parties? And I guess like, what about like the relevant in size? I'll share a rule of thumb that I've heard, and I don't know if it's appropriate. And they're rules of thumb for a reason. Is never buy a company that's more than half your size, because otherwise, like, you can have conflicting cultures where the other culture might win.
Yeah. On that metric, I would say even 50% is probably a pretty bullish. It's probably more like 20 or 25%. Because integration is a bear. And I think that's where a lot of firms miss the opportunities, is in the integration. And trying to integrate a firm that's 50% of your size, I think could potentially be really disruptive. And you're right, maybe even destructive. So that rule of thumb is probably more like 20 or 30%, 20 or 25%. As far as raw size goes, I mean, you're right. It touches on an issue that we talked about earlier with transferable and institutional value. And all things being equal, a firm that's 5 or 10 employees probably has a lot of the value tied to 1 or 2 key individuals. Perfect world, I hear buyers say we don't buy anything under 50 employees. 50. And the reason for that is their argument is it's just as much work, sometimes even more work, to buy a 10 or 20 person firm, because the books can be messier. You can get the cash basis financials, you get all those issues that we talked about earlier. And the 50 person firm just moves the needle a lot more than a 10 or 20 person firm. But
The return on your time,
yeah,
like you
yeah,
said,
for
like
sure.
generally
But
size are going to
something
be
we
more.
have started to notice a bit is as buyers are getting more experienced, um, buyers are getting smaller. So and as we're getting into this situation of what I would call acqui-hires, that is, you're acquiring to kind of pick up talent. Um, I'm seeing more and more.
I
It
like the
used to
word.
be that the typical acquisition in this space was a 300-person firm buying a 50-person firm or something like that. But we're starting to see more of the 50-person firm buying the 5 or 10-person firm,
Hmm.
just to acquire talent. Uh,
Yeah, I think there's a good strategy there. Like if you can't capture the talent and you know this team's solid, and you have the work, then it's a
yeah.
strategic play
The
to
tricky
find that
part there
talent,
is
right?
like, all right, forget about what I said about EBITDA then. Now we're looking at what would it cost us to hire a recruiter for that many people. I mean, that's got to be,
Your opportunity cost, yeah, your best alternative,
yeah, for sure.
right? Your best alternative to a
Yeah,
negotiated
the
agreement.
BATNA
And like
for a
when
moment.
you have your
Yeah.
BATNA, yeah, when you have other costs that add up, then you're all of a sudden willing to pay more money. The challenge in that strategy is chances are that other company has a book of work that they're also working on, and I would say a 5 to 10 person company is generally overwhelmed. So you're going to be working off their work and trying to get them over to your key clients. Like that's not an easy
Yeah,
path
the
either, right?
real unicorn there, if you're just looking to acquire talent, you are absolutely right. That any firm worth buying is usually having the exact same problem you have, but every once in a while, you'll find a unicorn where it's a 70 or 75-year-old owner who in this case you actually do want some of that non-transferable value, because you're saying I just want like
Mhm.
10 architects or engineers that I can dump a bunch of work on. So I actually
Yeah.
love that he wants to retire
Yeah.
and he's going to lose a bunch of clients. But those are
You only have 6 months of backlog, and yeah, that's a good buy, right?
the worse the better. I just want the people, but those are pretty rare.
All right. And so to kind of, we'll get to our last few questions, but to share for those people like Greg, you, your team, everyone at PSMJ is a great resource for anyone that wants to learn more about business valuation or mergers and acquisitions, even direct consulting, like you said, like you have educational resources, events, and consulting. Where do people find you? How do they learn more?
Yeah, so psmj.com is the best place to go because, like you said, by design, we're kind of a Swiss Army knife. We've never wanted to just be advisors or M&A consultants. We recognize that there are a lot of people out there that don't need that, don't want that, and don't want to pay for that, and they shouldn't. For some organizations, it's a matter of just learning the basics of the process and what they need to do. So, as I kind of zip through in the opening there's like all this different stuff we do on the business performance of AEC firms, but the website is the best place to start, I think, to kind of look at where we can help you for sure.
Absolutely. And we're personally members of the PSMJ Executive Forum, which is a group of executives across the architecture and engineering world that kind of share lessons learned and pose questions to the group. It's a group worth being a part of for sure.
Been a fantastic part of it, Renz. Yeah, that's our PSMJ Pro membership community, which really took off during COVID when executives were just looking for that conduit to share best practices and questions and challenges. So that group has grown considerably since COVID for sure.
It's a great resource for sure. We'd recommend it to anybody. And 2 questions to close out here. Do you have a top book or a top podcast you'd like to recommend?
I do, actually. I kind of have one of each. So there's a book that it's a few years old now, but it's called The Company We Keep by a guy named John Abrams that actually had a design build company on Martha's Vineyard. And the reason for that title is he talks about how it's a great case study in ownership and leadership transition. And he kind of has this philosophy that I'm just a steward of this company. Okay, it was called South Mountain Construction Company, I believe. And he talks about how he wanted to build institutional transferable value and didn't want the company to be him. I mean, he was just doing the best he could to leave it better than when he created it. So it's a fascinating story of his journey through transition. So The Company We Keep. A podcast that I actually really enjoy is called The Idea Cast by Harvard Business Review, Harvard Business Publishing, I guess. That obviously, like a lot of HBR stuff, is real focused on big kind of Fortune 500 organizations. But every episode that I listen to, there's a nugget or two that you can take and apply to an architecture engineering firm for sure. So check out The Idea Cast if you haven't already.
2 great recommendations, and I love that book title, The Company We Keep. I think just the title alone kind of sends you a message to be paying attention to spend time with. And to close out here, advice for emerging leaders.
Lean in. I think there's so much opportunity to learn about this business. Podcasts like yours, Renz, and so many other great resources that it's never been easier to get great business advice, whether it's industry specific or general, like the IdeaCast that I just mentioned. So just lean in and be a sponge in all that stuff, and you'll be amazed what you can learn. Even if you've never been to business school, don't have an MBA or anything like that, there's so much to learn for sure.
As a lifelong learner and someone who's personally benefited from access to education like podcasts and books, like I can get behind that advice. Greg, thank you so much for your time today. I love the mission and what you guys do at PSMJ. Thanks to you, Greg, and Frank, and everybody else. And thanks for being a part of the design development community.
Thank you, Renz. Appreciate it.
Everyone, can't thank you enough for tuning in today. I hope you got a ton out of today's conversation. And if you could do us one favor, if you did get value, please like, share, and comment. Subscribe on whatever channel you're tuning in on Please leave a review. It helps us expand and grow and support more people. That's the end goal. We want to bring the insights of these amazing guests to as many people as possible. Thank you.